beautiful door prizes, because after we've had this very interesting presentation and seminar, I would love your comments on that. And that is actually how we build our programs. And I'm glad to say that we've gone from 95 to 99% good to excellent. So no pressure, guys. Oh. But this is really, it's really important, and this is how this program came about today, because we were collecting these and everybody's like, financials, we really need to understand our financials. So it's really critical, and it builds our programs for the next year. So with that, I see Bill has come in now, and he'd like to say a few words to us. And then we will turn it over to Melinda. And just before, I will run around and get your business cards for the entry when we do our survey. So come on up.
I'll just chat from back here.
Okay, chat from back there.
We'll test everybody's flexibility here. So, guys, I'm Bill Watson. I'm with Hudson, and Russell is over here in the corner, our king of operations, to help the technical aspects of it. But we're very close with your organization, and welcome you guys and gals to Hudson. If you need space for your some of your meetings or projects, we have 15 classrooms, 30,000 square feet here. So please think of that. And of course, Hudson's in a good place. I'm kind of see so many familiar places you've heard me talk about this. Our biggest graduating class ever, projected for May. Our enrollments are up 19% for the fall semester over the previous year. So we are doing some things right, we think. So, but welcome, glad to have you here. Look forward to learning something about finances myself. So thank you.
Ta-da. All right. Good morning. Good morning. I think that we have the ability to use a microphone, but I generally don't have a hard time with people hearing my voice. Is that true for today, or should we use the microphone? We're okay? All right, great. So good morning. My name is Melinda Irish. I am an auditor with Baker Newman Noyes. I'm a senior manager. I've been there for 14 years. And today, my part of the presentation is really going to be walking you through some key concepts that are going to be helpful, some vocabulary and some terms that you're going to be hearing throughout the presentation. I'm then going to walk you through a set of basic financial statements. We're also going to talk about the users of the financial statements and why that's important. And then the overall theme is going to be why this is important to your company and why focusing on these details could be helpful to your organization. Oh, thanks, Dean.
Hi, my name is Dean Michaud. I'm with Michaud Accounting Solutions. We offer CFO controller solutions. We offer business process analysis and process improvement assistance, and we also work with accounting groups and businesses on various projects, such as software implementation, other streamlining projects that you may have. We also do cloud accounting software upgrades and implementations. I am a CPA. I have 21 years of experience. Got my start with Baker Newman Noyes. Melinda and I have known each other for several years. Worked in various positions in corporate accounting, from a controller at a manufacturer to my most recent position prior to starting my consulting practice was with IDEX Laboratories. I was their corporate accounting manager. So today I'm going to talk to you guys about the value of data and how we use that data to successfully manage our businesses and how that ties into reporting. And then we'll pass it over to Brian.
Sounds good. My name is Brian Deveaux. I'm the Chief Financial Officer at Hussey Seating. And I want to ask people to raise their hand. Raise your hand if you are not an accountant in this room.
Oh, wow,
yeah. Oh, my goodness.
and the reason that I want to ask that is because I think it's important for people to understand that you don't have to be an accountant to run a business and to effectively utilize financial information and operating information. I'm going to talk some about financials to kind of continue the theme, but also talk a little bit about on the operational side of things. And I think sometimes people can get intimidated by the accounting aspect of things and debits and credits, and that's what we, and we as a firm rely on Baker, Newman, and Noyce to help us with that. But it doesn't need to be intimidating, and I'm proof of that. So I'll try to impart a little bit of that on folks today.
Great. I'm going to stand up. I hope you don't mind. I can't possibly sit down during the presentation. Do you want me to take that?
Absolutely.
And out of concern for Dean's safety, I tend to talk with my hands a little bit. It'd be safer for me to be up here, I think. Before we get into these key concepts, I just wanted to talk about 2 quick points. Number 1, I mentioned that I'm an auditor, and yes, that's true. It's what I've been doing for, I think it's fair to say, the majority of my career. But prior to that, I worked in industry. So I worked for private companies, 3 in fact. All 3 were small, closely held companies here in Maine, 2 of which were family-owned businesses. And I mention that because I just want you to know that while I'm going to be looking through the lens of an auditor for a lot of what I'm talking about today, that I'm going to be drawing on the experiences from both careers, if you will. Secondly, I wanted to talk very briefly about why people have audits, because it's going to come up in the presentation when we're talking about why things are important. So I thought it would be helpful for me to kind of look at what my book of work is and why my clients are having audits. So I looked at just my busy season clients, just my commercial clients with 12/31 year ends. And I found that just shy of 70% of my clients are having audits done because it's required by a bank. And we're going to talk a lot more about that. But now over 30% of my personal clients are having audits done because they're new early stage companies who are looking for capital, they're looking for investors, and they're having audits done to confirm the financial stability of the organization. And I thought that was really interesting because, number 1, 5 or 6 years ago, I don't think that would have been the case. There's a lot of economic development in Maine. I also do some work in Massachusetts, and that's really where my book of work is shifting to. So that's really helpful, and we're going to see a lot of that help and that assistance come through today, because that's where I'm really seeing my ability to help my clients, and it's where I'm seeing them falling down a little bit short on the analysis and financial reporting, in part because they're early stage in the company and they haven't invested the resources in their finance team yet. And I think that if you look at why those sets of clients that are having audits done for that purpose, and my other clients who have been having audits done for years because they have a credit facility that requires the audit, really different risk profiles, really different ways people are looking at things, and that's definitely going to come through today. I also wanted to say briefly that this is a how-to. This is the series, the how-to series for the Institute for Family-Owned Business, but today we're going to be focusing a lot on the why. And so I'm going to show you obviously how to read a basic set of financial statements, and we're going to talk about these concepts. But I really hope you hold me to task on the why and pulling that together and why this is important. And if I'm not drawing that conclusion for you, please feel free to speak up. For me in particular, feel free to ask questions throughout, and there will be a Q&A session at the end. And so before we get going on looking at a set of financial statements and even looking at who's looking at our sets of financial statements, I thought it would be best to start with some key concepts and terms that you're going to be hearing throughout all 3 presentations, in particular my own, but also to get some vocabulary out there, because as Brian said, you absolutely do not need to be an accountant to be able to do this work, to perform this analysis, to take responsibility for these numbers. But in order to do so, it might be helpful for you to kind of understand some of the acronyms that we're going to be using, some of the terminology that we're going to be using. And the first, I think, is the most important to me personally with what I do as an auditor, generally accepted accounting principles, GAAP. You're going to hear that a lot from me today. It's really the Bible that I work through with what I do. So it's the framework that the Financial Accounting Standards Board, the FASB, uses as a foundation for their basic sets of rules for standard financial statements. And so as an auditor, my clients are looking to me to provide an opinion on their financial statements saying that they are materially correct in accordance with GAAP. And the way that I look at GAAP is really a way to level the playing field for all companies. It's a basic set of rules that everybody needs to follow. Just think about how not helpful it would be if everybody was able to recognize revenue the way that they chose to and not based on these standards, or if they valued their inventory based on the way that they think that they should, or based on what they think it is worth to them. It'd be a very different picture than looking at a set of financial statements that's based on GAAP. And I just wanted to make that clear because it's really going to shine through on the conformity that we're talking about today. We're going to talk about transparency, conformity, analytics, and I think it's important to just know that that's all based on GAAP. Cash versus accrual basis of accounting. Okay, this is definitely big. A cash basis of accounting means that you account for transactions as the cash transaction occurs. So when you're making payments for goods and services, you would record those goods and services. And when you're paid for revenue for sales, you would record them at that time. Now, as you can imagine, that really would create a lot of difficulty in showing the financial performance during one period of time because there's no real cutoff for that period, meaning that you could have transactions that really related to a previous period being recorded in the current period and vice versa. Accrual basis of accounting is definitely the preferred method, and it means that expenses are matched with revenues. Revenues are recorded when they're earned, not when you're paid for them, but when you've satisfied the obligation that you need to earn that revenue. And expenses are recorded when the economic benefit has been gained from whatever it is that you're paying for, whether you have received the inventory or whether you have received the services for professional services. It's really capturing that expense in the time frame for which it was benefiting the organization. As you can imagine, that creates a clear picture at any point in time, whether you're looking at things on a monthly basis, a quarterly basis, or an annual basis. You are showing a true picture of the performance for that period of time. Consolidated financial statements. I threw this up here because this is a concept that's becoming more important because companies are looking at different corporate structures. Companies could have a parent company and they could have subsidiaries. And what I'm seeing a lot of these days are entities that need to consolidate other companies because they're variable interest entities. I'm definitely not getting into that. That's definitely a concept that we could put a whole class around. But the reason I'm bringing it up is because you need to make sure that when you're looking at a set of financial data that you understand the players that are involved. And if you don't have a full set of financial statements where you're showing a set of notes to the financial statements that would go into detail about the entities that are included in the statements, at the very least, you should have that defined on the face of the statement so the people that are looking at the information, using it to make decisions, understand what is included. Comparative financial statements. You'll see in your presentation materials, there's a set of financial statements that we're going to be walking through today, and I've copied them because the slides are really small. I've copied them in full in the back. And the reason I'm pointing that out to you is because, having comparative financial statements, having comparative data is really the most basic of all analytical procedures. I cover a lot of analytical procedures in what I do as an auditor. The two most basic and common are scanning, looking through a population of information and looking for things that are unique or unusual, and then also comparing two different time periods. And looking at a set of financial statements that compares 2017 to 2016 is really the most basic way for you to look at that data and see what might be different between those two time periods. So when we're talking about comparative information, that's why it's important. Good data and transparency in financial reporting. That is the common thread throughout today's presentation. I'm going to be talking about its importance in classification and how to make sure that that all of the information that you are presenting is transparent, the users understand the terms that you're using, and then Dean's going to be taking that to another level when he talks about the analysis of that information, and then Brian's going to really bring it home with some good examples about how his company used that good data and timely information to make business decisions. And then I would be remiss if I did not bring up internal control environment and its impact on financial reporting, because that's what I do every day. When I'm working on audits for my clients, I am looking at their internal control environments and I'm giving them feedback about what that environment means for their financial reporting. And we're going to talk about that in more detail. I'm not going to get too much into it now. But if you just think about the fact that if a company did not have good controls in place, they were not reconciling their information on a regular basis, and if they did not have people looking at transactions, journal entries that are posted, things like that, and looking at just the overall tone at the top of the organization, how things could easily be wrong, and have people not notice it timely, and what that means is that information is wrong. And what that further means, and this is the theme of today's presentation, is that companies could be at risk for making decisions on bad information and really what that could mean for your organization. So with that, we will move on to learning how to use the clicker. My second adventure of the day, the first being printing the materials for you all today.
Nice job.
Oh, thank you, thank you. I think yesterday or today was administrative assistant day, and I hope you all appreciate those people in your life because they are very important to me, that is for sure. So let's talk about the users of the financial statements, and we're really going to talk about the why here. It is really important to understand the uses of your financial information, because if you do that, then you can make sure that you're meeting the obligations of those users and you're giving them the information that they need in the format that they need it. So senior management, people like Brian, who he's going to step through a number of things that he does on a regular basis to analyze financial information. It's really important that they have timely information to make these decisions. In one of my previous experiences, I worked for a marketing firm. And right before I started, they got a new CFO. And this CFO really brought financial reporting to a new level. Previous to that, there was a lot of issues within the organization with different practice areas not taking responsibility for the performance of their practice area. And what the CFO, my boss, did when she came to the organization is she said, look, we're going to have to take a look at things in a different view. If we're going to practice responsibility accounting, we have to be able to give people the information that they need to be successful in their roles. And so we took the financial reporting package, we broke it all down by practice area, we even took our overhead, the costs that are not identifiable to an individual practice area, and we allocated it based on headcount. So basically at the end, we had individual income statements, profit and loss statements for those practice areas, and then the managers of those departments had the information that they needed to be able to make those good decisions, take responsibility for their practice areas, and it really strengthened the organization. So that's the reason why I put that at the top of the list, because I think they're the first people that are going to be using your statements and really thinking about why it's important that they have that accurate information in a timely fashion. Stockholders and stakeholders, so these are people, this is Maine. We're mostly closely held companies. There's not a lot of public companies here in Maine where you have the traditional stockholders that you would think of. Here in Maine, we have mostly family-owned businesses, right? So the stakeholders, the stockholders could be different. They could be looking at this information for different reasons, but overall, they're looking at the performance for their stake in your organization. And so knowing that they're going to be using that information to make decisions about the future of the company is really important for you to realize. The board of directors. So I sit in on a lot of board meetings. If there's an audit committee meeting, I'm usually sitting in on the part of the board meeting as well. And so I'm able to see firsthand just how board members and audit committee members are using internal financial statements and audited financial statements to make decisions about companies. I recently sat in an audit committee meeting that was fairly contentious because there was a disclosure in the financial statements that really gave rise to some concern about some transactions that had occurred at that organization. And it really made me, it's obviously a difficult situation to sit through any contentious conversation, but it was helpful for me to see and helpful for our audit department to see, or our team, I should say, to see just how much time was being spent on, remedying that situation and understanding what caused the situation. So it's important for you to know that financial information is going to be seen by people far beyond your immediate reports. Banks and other lenders, we're going to talk a lot about this because it's really important to understand that some of the transactions that you could be recording and some of the ways that you present financial information has a large impact on banks, especially if you have a credit facility, if you have a line of credit, or if you have a term loan with a bank, because they're going to be looking at that information for specific reasons, and we're going to talk about those. Potential investors, and in the beginning I talked to you about why people are having audits, and this is an increasing pool of people that are looking to internal and audited or reviewed financial statements to look at the financial stability of that organization to see if it's an organization that they want to invest in. And tax preparers. So after I'm done with my audits, I hand the information off to our tax team. That could be external tax preparers. It could be your internal tax department. But just know that the information needs to be accurate because you're going to be paying taxes based on that information, and your deferred taxes may be realized or not based on the way things are reported. So just know that it doesn't really stop with financial reporting. There's that next step, and that is that's tax preparation. And then employees. So it depends a lot on the transparency in your organization. Some organizations are very, very open, even closely held businesses, with their financial data, and they share it with their employees on a regular basis. Sometimes they just share it, pieces of that. The amounts that, the balances or the transactions that relate specifically to a practice area that you are a part of. But just know in the end that employees have a stake in the financial health of the company. Their jobs could be at stake. The growth of the company that they work for could be at stake. Bonus plan, other compensation elements could be at play here. So just don't forget that the financial reporting also is largely impacting people like yourself within the organization. So these are the users of the financial statements, and we're going to talk about each one of them and as they relate to the statements that we're looking at. So the elements of a full set of financial statements. Unfortunately, this would have to be a full morning presentation for me to be able to step through all of these. So we're going to look at the three most common. A full set of financial statements would be a balance sheet. We're going to look at that. An income statement. We're going to look at that. Changes in stockholders' equity. We're not going to take a close look at that. We're going to talk about equity transactions. But I think it's important to note here that changes in stockholders' equity, and this is in part why I chose to pass on this, is going to look very different depending on the organization, depending on your corporate structure. You could have it be as simple as common stock and retained earnings. It could be as complicated as having preferred stock, as having some convertible debt, things that a lot of complex equity transactions running through there. So we're going to pass on that, but just know that that is part of a full set of financial statements. Statement of cash flows. That's a really basic statement that has so much information in it. So there's no way I can pass on that. And so we're going to take a look at that. The notes of the financial statements. Unfortunately, there's just not a lot of time to go through that and what could be included. But I just wanted to point out that. That the notes of the financial statements are really the supporting information to the details on the statements. Some statements are more detailed than others, and the notes really help add context to the numbers. It outlines the accounting policies of the company. It breaks out balances like inventory, equity, sales into greater detail so that you can look at things at a more granular level. And then it has disclosures about related parties, risk and uncertainties within the organization, and even debt obligations. When we look at our balance sheet, we're going to see that debt is represented on a couple of lines, where in the notes to the financial statements, it's a healthy disclosure that takes up a significant amount of real estate in the footnotes. So just know that there's an additional step that we're not going to get to cover today that really we're going to talk about. that we're not going to see examples of. And then there's also potentially, depending on your organization, a need for some consolidating schedules or other supplementary information. If you are showing consolidated financial statements, it's often helpful to show the activity within each of the entities, and then the eliminating activity, that intercompany activity, sales to other, to entities within a consolidated group. Sometimes that's helpful. It's not always included. Sometimes you break out your general administrative expenses. Again, that would be one line on the face of the financial statements. So I have a lot of clients that find it helpful to have a supplementary schedule that supports that breaks it out into greater detail. So we're not going to see an example of that, but just know that there's a fair amount of flexibility in the way, as long as we're in conformity with GAAP, of course, and the way that you present that data. So moving along here, just bear with me. Okay, so the balance sheet. So I wish I could see this. I'm just going to come out here if you don't mind. And I'm going to kind of refer back to my notes too, because this is how I'm keeping myself on task today, because already halfway through the presentation, my goodness. My goodness, this is just fascinating stuff to me. I could talk about it all day long, and I'm happy to do so if you all have time to do that. But for today, out of respect for my co-panelists, I will stick to my time. So the balance sheet, the basic formula for the balance sheet is assets equals liabilities and owner's equity. So I've got an example for you here on the screen. It's comparative, as I spoke to earlier. It's also in your materials in case it's more helpful to you to take a look at it there. I wanted to talk about a classified balance sheet, because as you can see, this balance sheet is broken out into categories that are helpful to the users of the statements. And that's really all that a classified balance sheet is. Technically, one of the criteria for classified balance sheets is that you're breaking out your assets and your liabilities into a current and long-term presentation. And that is, I think, one of the most important aspects of a classified balance sheet, because it really helps the users take a look at the components and say, okay, here are my current assets. And current assets or current liabilities mean assets or liabilities that are going to be realized in the upcoming year. Okay, so cash is obviously liquid. Receivables, these are receivables that we're looking to collect within the upcoming year. If you have long-term receivables, it's really important that you reclassify those out into other assets. Those are other long-term assets, because then the user can look at the statements and realize that they're not going to collect on that receivable in the upcoming period, and therefore they can't count on it to meet obligations. Inventory. I spend weeks at a time on inventory. Inventory valuation is huge. It's a huge part of audits. It takes up a lot of real estate in the footnote because there's a lot of disclosures about the inventory. But note here that it's for manufacturing companies that I work on a lot. It's oftentimes one of the biggest numbers on the balance sheet, and it's really important that you understand how that inventory is valued and a number of other things that I unfortunately don't have time to get into. Prepaid expenses, this gets back to the accrual basis of accounting, okay? So if you paid for something in a previous period that you're not going to realize until a subsequent period, you record it as a prepaid expense, so that you're just recognizing that you have an asset that you're going to be realizing in an upcoming period, but that you haven't yet. So that's an asset to you until you have. Taxes receivable, I included this because this is a corporation, okay? These are a set of financial statements for a corporation, so there's going to be taxes included. You're going to have either a tax receivable or payable, generally speaking. You might have some deferred taxes. I could talk hours about deferred taxes. And there's just a difference between book and tax assets and liabilities, another big part of the financial statement disclosures. I put that up here just to point out just how important it is to break that out, right? We're doing a classified balance sheet, so it's important that we have taxes classified separately from trade accounts receivable. This is the accounts receivable would be receivables that you generate from selling product or services. And then also due from shareholders. We talked about having disclosures about related party activity. It's also broken out on the face of the financial statements. Fixed assets are assets that are longer in term and that are fixed in nature. They're tangible. They're not intangible assets like goodwill and other intangibles those are broken out into other long-term assets. So here, so far, with just what we've covered so far, we can see that we understand what are the assets of the company that we're going to be able to realize in the next period, what are our fixed assets that we use for operations, or maybe not, we'll talk about that. And then our other assets, which are longer in terms. So that deferred tax asset here is an asset that is going to be realized in a future period, not the upcoming period. And deposits are usually what we find down there in other assets. That's what the 16,000 is. That gets us to total assets. Now remember, our formula, assets equals liabilities and owner's equity. Other side, liabilities. So classified balance sheets, what's important that we classify our debt accordingly. So we've got a line of credit. That's an on-demand note. So it's something that we have as a current liability. We have long-term debt in the middle of your statement. That's obviously debt that's longer in term and due in periods after the next year. But we've taken a part of that and we reclassified it up to notes payable current portion. So that's really important. You've got several pieces of debt here, and there could have several pieces of debt, maybe not, but they're classified separately on the financial statements because it's important to the user to understand the difference in terms in those debt instruments. Also, traditional liabilities would be accounts payable and accrued expenses. Accounts payable, obviously, just payables that you have for invoices that you've received for goods and services. But accrued expenses gets back to that accrual basis of accounting. If you haven't received invoices relating to, say, we're talking about the year of 2017, you're not going to receive all of those bills by the end of the year. So you keep your books open for a certain period of time into 2018. You collect all of those invoices, and you accrue for them. And you show it separate from accounts payable, or not. Some people accrue it right into accounts payable. And then we have equity, and we're not going to spend a lot of time on this, but this is a pretty basic equity structure for a corporation. We've got some common stock that was issued at one point in time. We have some additional paid-in capital that's contributed capital to the company, but not for the purchase of any shares or securities. And then we have retained earnings, and retained earnings are the accumulation of all the profits and losses since the beginning of the organization. And so this accumulates year over year. When you look at this right here, the difference between 2017 and 16 is $500,000, and that is the net income from the previous period. So that's our balance sheet. Now, other considerations, I'm going to have to talk really, really briefly about this because we're going to move along, but these are things that you should be thinking about when you're looking at your balance sheet. Making sure that you don't have any impairment, meaning that your fixed assets are not damaged in any way or obsolete in any way and need to be written down to the value that they'll be realized. This isn't to suggest that we're fair valuing our fixed assets on an ongoing basis, but you do need to recognize if there's damage or obsolescence in your fixed assets. Idle assets, if you have assets that you're not using in operations, it's important to break those out because they're not being used in operations and they shouldn't be depreciated. And so if you are a fish processing company and the shrimp season in Maine has been shut down for a number of years, but you still have your shrimp equipment, you should be taking that and pulling it out of fixed assets, showing it separately, stopping depreciation on it, and instead evaluating it for impairment period over a period. The impairment we just talked about, if it's deteriorating in any way. Qualification for asset-based lending, it's really important that you take a close look at any of the assets that that the bank is lending you money based on. Not enough time to go into all the complexities of that, but if you have tainted receivables, if you have receivables that are over 90 days, the bank isn't going to allow you to borrow on those amounts. So it's important that you just keep the records cleaned up, and so there's no surprises when you send your information off to the bank and you're looking at what your available credit might be. Impact on bank covenants. I wish I had more time to talk about this because, again, getting back to the onset of my presentation, that's why a lot of my clients are having audits, because the bank is requiring it. So that in itself is a financial covenant. Audited financial statements within 90 or 120 days after year end, excuse me. But also there's certain calculations. There's debt service coverage ratios that could need to be met. tangible net worth. There's a variety of different requirements that could be placed upon the organization in order to meet those banking covenants. And it's so important that you're looking at that period over period. It's usually based on a trailing 12 months. And you could really, I've seen clients who are not paying close attention to reconciliations and to the contents of these accounts. They're reporting to the bank all year long that they're meeting these financial covenants. And then once the audit is done, the adjustments have been made, they see that they in fact did not meet the covenant, and then they're in failure, they're in violation. There's consequences to that. Sometimes they're severe, sometimes you can get a waiver. It's just really important to know that that requirement is there. Related party activity, we talked briefly about that, but it's just really important for the users of the financial statements to know what is with a related party versus with an organization that's not related to the company. I don't have enough time to talk about liability versus equity presentation, but I put it on here because a lot of my clients, especially those that are looking to raise capital, are entering into some pretty unique agreements. And sometimes they don't realize that the agreements that they're signing have accounting consequences to them. I have a client who was caught off guard with a large compensation charge for some stock options that were issued. I also had recently had to qualify a report, not able to give an unqualified audit opinion, which is always the goal, because the client had entered into this agreement that was basically a call option, and there was a lot of complexities in how to account for that, and they elected to have a qualification instead of doing that. So just know that, while I don't have time to go into detail, that it's important for you to understand the consequences of agreements that you enter into. The income statement. So the income statement is pretty straightforward. It's breaking down all of the sources of the revenues, the way that you earn your money, and then all of the expenses that you have. And it comes down to the bottom line of net income, right? So that's where everyone's eyes are drawn to. What is the net income? What is the ultimate profitability of the company? But the point I want to make here is that the classification of the income statement is absolutely paramount, and your ability to analytically review this, even just looking at a basic set of statements. Brian's going to talk about breaking this out into greater detail, but when you're looking at these statements, I mean, this is some powerful information just based on the way that you're classifying the revenues and the expenses. It's very important for you to, in order to come to a true gross profit, to make sure that the revenues that you're including above the line are revenues earned from operations and not from selling fixed assets or other unique transactions. It's really important that you're breaking out your cost of goods sold. This is a winery, so those of you who know me are not surprised. The cost of actually bringing that product to your customer, the cost of the inventory and all of those, what we sometimes refer to as direct costs, the costs that are directly related to the revenues that you've earned. That brings us down to our gross profit. But there's a lot of other expenses, right, that you run into in running a company. Operating expenses, those are your sales and marketing, your R&D, salaries and benefits, and general administrative. So those are other costs to operate, right? But they're not necessarily up above the line. And then down below, it's just really important, I won't spend a lot of time on this, to break out things that are not transactions that were not generated by your normal course of business. So if you, you're not a bank, so you're not, interest expense is something that it's not part of operations or up in cost of goods sold, although a lot of my clients think that it belongs there. Gains and losses on disposals of assets and other income and expense that are generated for whatever purpose. Other considerations are just to make sure that you're looking closely at where your taxes should be recorded. The taxes down below the line here, income tax expense, I'm seeing frequently that people are putting other types of taxes in that. And it's important to know that sales tax that are for the inventory that you're purchasing for that you're selling would obviously go in that category, and just to pay close attention to that, because where I see a lot of companies falling down is not classifying things appropriately, and then when they're doing analytics, they're not even in the right food group. Forget about comparing apples to apples. They're just really, off base. Cash flows, and I've got to stay on task here, so I'm going to briefly talk about this. It's very self-explanatory, but I really wanted to point out what a powerful tool it can be. This statement is broken into 3 sections, okay? These are the cash flows. Where did my money come from and where did it go? It takes your cash from the beginning of the year right through to the end of the year, period. I should say period because this can be prepared on a monthly or quarterly basis as well. And it shows the user exactly the sources and uses of the cash. Obviously, you have net income. And there's some amounts that need to be considered that are not necessarily the change in balance sheet accounts like depreciation, gain on sale of equipment. Those are considered items that need to be looked at separately to reconcile net income to operating activities. But then from there, your change in operating assets and liabilities, that's basically the change in the balance sheet. When you're looking at those amounts right there, and if you were to take that and line it up with your balance sheet, you're going to see that inventory must have gone up, and that was a draw of cash, and so the cash went down, the $90,000 because of it. Okay, so I just want you to see the relationship. We could go into a lot of detail there. And then the cash uses and sources from investing activities. So if you're buying capital equipment, if you're buying machinery and equipment, if you're investing in your plant, that is obviously not a part of operations, but it's truly a way that you're drawing down on your cash. Maybe you sold some equipment, that would be included in that category as well. And then from financing activities, these are going to be really the activity with your debt, with your credit facility. It's going to show the payments of net payments for your line of credit, whether you're drawing or you're paying, and then any repayments of your long-term debt. And so the users of the statements can take a look at this and they can see, look, I am generating cash from operations, positive, always a good thing. And then looking at where are the other sources and uses of the cash on the balance sheet, where they came from. So I'm not, unfortunately, able to spend too much time on that. So I just want to break this down real quick before I hand things over to Dean, and he's going to take it to the next step. So why do we care? Why is this important? Understanding your company's financial statements means that management, the owners, the family, all can have accurate information to make your business decisions. Be certain that there are sufficient assets to cover upcoming obligations for that classified balance sheet we talked about. Having accurate information to budget for future periods. Dean's going to be talking about that for sure. Having the ability to plan for future growth and how you're going to fund that growth, right? You're going to be looking at your cash flow a lot for that. So you can see historically where you've been generating that cash and how you plan to going forward. Being sure that potential investors have accurate information to base their investment on. And, oh, there you go, sorry, look familiar. And what if you don't understand? Well, what are you putting the company at risk for by not understanding? You could be at risk of not being able to make those obligations. You could be at risk of making poor business decisions because remember, if you've got bad data, you could be making poor business decisions based on that bad information. You could be at risk for failing financial covenants, and there could be related consequences. Some of them are severe. Risk of losing confidence from investors, the bank, or even your employees. And the risk of increased audit and tax fees, because when we have to spend more time on the audit and when we have to spend more time preparing your taxes, unfortunately, that's not free. And so that is another risk that you do face by not putting the investment in your financial reporting. So thank you for your time, letting me step through that with you. And now I'm going to hand things over to Dean so he can take it to the next level.
Whew, that was a mouthful.
I know.
Breathe.
All right. I was trying to breathe
All
for
one
you.
breath, all one breath.
I was trying to breathe for you, Melinda. So.
I appreciate that. And you know, I didn't shave off that 5 minutes I was looking for. I apologize.
It's okay. It's okay. So just to tie in what Melinda was talking about into what I'm going to talk about today, Melinda talked about the importance of financial information to third parties. I think, when I look at everything she's saying up here, obviously, for people who are not accountants, this is a lot to take in. I think one thing you take away from this is there's a lot of detail that needs to be managed, right? Why do you care about that? Why is it important to you? And I think some of the key takeaways for me in what Melinda was talking about is if you need financing from a bank or from investors to be able to continue to grow your business, if you don't have this information, it's going to be hard for you to take that next step. So it's important for you as a business owner to make sure that you're collecting that data in a timely and accurate fashion so that when it's time for you to go to the bank and ask them for help or to go out and seek investors, you have the information prepared so that they can help you. Otherwise, that's going to really slow your process down. The other piece for me is, just from an economics perspective, if you're not doing a good job of maintaining that data, when the auditors come in, it's going to take them a lot more time. It's going to take you a lot more time to go through that process. You're going to have to spend a lot more time working with them. Not that you don't want to, but you're going to have to spend a lot more time explaining things, providing more information to them. The more complete your information, the more efficient that is. It's not just time, it's money for you. Same with your tax returns. If you are keeping track of that information well, your tax accountant is going to be able to leverage all of the tax rules to give you the best benefit he can give you. If you don't, it's really hard for them to do that, right? And the challenge, as you all know, for tax accountants is everybody wants the same thing during a very short period of time. So the more you can help them and give them the information, I like to say, have you all seen Jerry Maguire? Help me help you, right? If you take care during the year to pull this information together and track it in an efficient way, then it's going to make our job easier to help you get the most benefit you can for your organization. So that's another key takeaway from me. And then the other takeaway is just regards to standard accounting methodology, GAAP, generally accepted accounting principles. As Melinda talked about, if a banker gets your financial statements, if an investor gets your financial statements, how do they know that information is accurate? How do they know what that information means? It's because you're following a standard of accounting, right? And you can apply that to anything, right? If you are a carpenter, you have a standard of how you build a house, or if you're an electrician, you have a standard of how you wire a house. Or if you're a manufacturer, you have a standard of how you manufacture your product, right? If you don't follow that standard, you're going to have problems down the road. So I think for me, those are sort of the key takeaways from what Melinda was talking about. So how does that tie into what I'm talking about today? Today, what I want to talk to you about is the value of data, right? The value of tracking data, having data at your disposal so that you can make good decisions for your business. Without data, it's hard for you to understand where your business is in relation to where you're going and where it is in relation to where you want to get to. I'll talk to you about some tools that you can use to help you make good business decisions, like budget to actual reporting, like key performance indicators and dashboards. And then one of the other key components of that is, as Melinda talked about earlier, is processes and controls, right? In order to track good data and have good data for good reporting, you have to have good processes and controls in place. So I actually invited a friend along today to help me out. I'd like to introduce you to Lieutenant Dan. And Melinda, I just wanted to say that, Lieutenant Dan told me he's pretty disappointed to hear about the shrimp industry in Maine. He's going to give Forrest a call and see what he can do to help us out.
That's all good.
So it's all about the data, right? It creates the whole story. So what I wanted to do today is kind of relate this to something that hopefully we can all relate to. Has everyone in the room been on a plane? Yeah. So what I did is I said, look, trying to think about a way to make this relatable to everybody. You're all in different industries. You all provide different services or goods to your clients. So I was trying to figure out something that could really ground everybody and bring it kind of down to that level of what does this mean to me as an organization outside of all this technical stuff that the banks and the investors want and the auditors want from me. What does it mean to me? Like, how is this going to help me on a daily basis make sure that my business is successful and I'm meeting the goals that I want to meet? So let's consider how Lieutenant Dan is going to get to his planned destination on time and what information that he uses to do that. So the first thing Lieutenant Dan gets is he gets a flight plan, right, from the airline he works with. The flight plan tells him his destination, when he's leaving, how far between his departure and his destination, and what the type of aircraft, right? Because the type of aircraft is going to make a difference in how much fuel he needs and other aspects of what he needs to do. So based on that flight information, he's going to figure out what speed he has to travel at. He's going to figure out what his flying altitude is and how much fuel consumption he's going to have, right? So how does he know if he's heading in the right direction and if he's on schedule? You know, and regardless of best laid plans, you could have a great marketing strategy, you can have a great business strategy, great business plan. You can spend a lot of time planning and do all the right things, but there are things that are going to happen that are outside of your control. Like with a pilot, they're going to run into wind, rain, storms, turbulence, air traffic. The air traffic controller comes on and says, "There's too much traffic. I'm diverting you." How do I get back on track to get to my destination on time and get to my destination? So pilots have tools, right, at their disposal. They have their flight plan that tells them where they're going to go. Oops, sorry, thank you. Their flight plan that tells them where they're going to go, and then they have a large instrument panel in front of them with all of these different gauges that give them information that they're going to use as they're in flight to identify where they're at and if they're at the right place. So you know, as they're going through that process and they're looking at their gauges, they're going back to their flight plan and saying, you know, am I at the right altitude? Am I on time? Am I going in the right direction? And so forth. So with all of that, even with all of those challenges and those diversions from the original plan, as we all know, most planes get there on time. They get to their planned destination and they get there on time, even with those diversions. So hopefully this kind of gives you a baseline to illustrate the value of data to an airline pilot. So now let's talk about, let me see here, just get back on track. Oh, the other things I wanted to consider are, not only does Lieutenant Dane have a flight plan and tools to assist him with meeting his goals, he also has very clear procedures which are followed, right? They do their pre-flight checklist. They make sure that everything is in order before they take off, and then they have procedures as they're in flight. And they also have procedures that give them steps to take if there's an issue in flight. They have a team who maintains the aircraft, checks it for safety before each flight, and a set of standards which all instruments are calibrated on a routine schedule to ensure that those instruments are providing accurate information. I think I got ahead of myself. So how does this apply to you and your business and reporting? So I also invited Pam to help us out this morning. Pam's ready to go. She's got her coffee. She's excited to be here and help me out with this. So how does an owner of a business or a manager of a business know if they're on track and meeting their plans? What information and tools do they have at their disposal, just like the airline pilot, to ensure that they're successful? So let's apply that flight plan logic to a business. So the where in my business is how much growth and profit do I want my business to have? So I start with my business strategy, right? I go through the process of understanding, what am I in the business of doing? What product or service am I providing to my customers? How much money do I want to make on that? How do I want to market this to my customers? How do I want to ensure that my customers are satisfied with my product? Those are all things we want to have in our strategic plan. We take that strategic plan and we build a budget. How much is it going to cost me to build that product? How much is it going to cost me to manage my organization? How much money am I going to make? What's my net profit going to be? So I build a budget that is a forecast or an expectation of how I think I'm going to do and how much it's going to cost me. So the where I'm going is how much growth and profit. The how is having the right resources, people, equipment, funds, how I'm going to market the product, as I said, and how I'm going to ensure that I'm providing a good product or service to my customers. And Brian's going to talk about this stuff as they apply it to Hussey and how he applies all this to his organization later. So you'll see how that all gets tied in as well. So as I said, just like with a pilot and his flight plan, a business, even with the best laid plans, is going to run into some challenges. They're gonna have human error. Maybe your budget expectations were off base, and you need to adjust those to what's more realistic for your organization. Maybe you expected that there was going to be more demand for your product or service, or maybe there's a downturn in the economy that's impacting your industry. So these are all things that you have to continue to monitor as you move forward during a period, because you want to understand how are these outside influencers impacting my business, and what can I do to help correct for that. So how does the manager know that she's deviated from her goal? She does a budget to actual comparison. Right now, she knows what her expectations were, and she knows what actually happened for a period, so she can see how she did against that budget. Right now, some of this may be, as I said, normal, but it's always important for you to understand why those deviations occur, so that you can make a good decision about your business. Okay? If you don't understand why they occurred, you can't take action. You can't make the adjustments you need to continue to have a successful business. So that's important. So like Lieutenant Dan, Pam not only has a budget and a budget to actual to analyze to help her stay on course, she also has key performance indicators. And Brian's going to talk about what key performance indicators they use in their organization to help them be successful and manage their organization. Key performance indicators are standards of performance based on industry standards. So they look at other organizations in your industry, and they look at what sort of the standard is as it relates to different factors within your organization. Some key performance indicators are margin. So we talked earlier about in your strategy, you want to have a certain profitability built into your business. Key performance indicators can help you with that. They can tell you what standard margins are for your industry. That will help with expectations regarding what your margins should be. That doesn't necessarily mean that you can't build in bigger margins, but it's an indicator of how successful you might be at the prices that you're trying to sell your product at. Days sales outstanding, that's measuring you. I'm sorry, that's an error there on that slide. It measures the number of days that it takes you to collect the cash from your customers. This is important because it can show the efficiency of your collections department, and it also speaks to your liquidity. If you have a lot of receivables that have been on your books for a long period of time, the longer they've been on your books, the less the chance that you're going to collect them. So that can be problematic for an organization. So that's why that's an important key performance indicator. Inventory turns, if you're in retail, or manufacturing. This is an indicator of how quickly your inventory is being sold. Again, that's important because if your inventory is turning slow, maybe you're manufacturing too much inventory. So you've got to look at that. Maybe we need to adjust our manufacturing. Maybe you have obsolete inventory. You have a product line that is no longer selling and it's been sitting on the shelf for a long period of time. So again, if you continue to manufacture that product, then you're just going to run into additional issues there. So you want to think about, if I have obsolescence, I want to discontinue manufacturing that product, and what do I do with these obsolete items that I have? And then the opposite is true as well. If you have high inventory turns, you could run into supply issues, which impacts your ability to sell and make profits. So balancing out your inventory with sales is an important aspect, and I'm sure that Brian will touch on that as they're in that space. So, and then working capital measures the cash that's available to meet your short-term obligations. Melinda talked about that earlier. When you look at the balance sheet and you see the short-term obligations, you know those are obligations that you're going to have to pay over the next year. How are you going to pay for that? Do you have the cash to pay for that? Do you have a line of credit to pay for that? How is your business going to be able to sustain that going forward? So that's another important key performance indicator. So I'll do it for time here. So now we have data, right? We've collected the data. We have our budget. We have actual information. We can create a dashboard, right? So the dashboard can be different for many different people. It really depends on the owner or manager and what information is important to them, right? But some examples of things you might have on your dashboard is cash on hand. That's an important one, because I want to know, I know I've got to meet payroll in the coming month. I know I've got payables I've got to pay in the coming month. So that cash on hand is important, especially if if I'm running tight on cash, which a lot of small businesses do, right? I know I do, because I'm a small business. So that's very important for us to see where our cash is. Working capital, gross margin. I had an expectation. I was expecting that where our margin should be 45%. And I see my actuals are showing up at 38. I might want to look into that. I might want to figure out, why is my margin lower than I expected? Maybe the price of the resources that you are using for that product have gone up. And you haven't considered that, because when you set your pricing, prices were different. So you have an economic influencer there that's impacting your margins. You want to understand that, because maybe you want to adjust your pricing, or at least you want to understand what that's going to do to your business long term. Excuse me, I need a little sip.
Yeah.
So we talked about data, talked about the importance of gathering data and the importance of how that data is used in financial statements, and the importance of having financial statements prepared in a standard format. So how do we get that data to the reporting? How do we ensure that we have good data and good reporting? So let's talk about that a little bit.
You might want to hit that button a couple more
I
times.
will. I'm just getting my bearings here.
I did the animation. They're so cool.
So again, now that we understand the value of the data and providing information to help us understand how our business is performing, how we're doing versus budget, and how we're doing based on industry standards, those KPIs we talked about, and how we can utilize this data to help us make decisions on our business, let's discuss the importance of ensuring that we capture that data accurately and timely. So I have my data, I need my reporting. How do I make sure that that reporting is accurate and that data is accurate? I build a bridge, and that bridge is process and controls, okay? She's very happy about this.
A little bit.
Yeah, so this is done by having well-defined processes and good internal controls over those processes. Consider that everything in your business impacts the financial health of your business, right? Whether it's sales, that's your income side, or all of your resources. If you need equipment, that's fixed assets. You need resources, you need people. So there's payroll, there's employee benefits. You may need, a brick and mortar, you need facilities. So everything you do in a business impacts your financial health. So everything you do in a business needs to be tracked so that you understand truly what your financial health is. If you're not tracking that stuff well, it's hard for you to have a clear picture of that. So well-defined business processes provide several business benefits. They align operations with your business strategy. Business strategy impacts all aspects of our business. Therefore, to ensure that we're working toward the goals set within that strategy, we need to build those into our process. It improves process communication. So one area that distinguishes successful businesses and teams is those that have a clear idea of what they're supposed to do, right? So if as an owner, I'm not clearly defining my employees' jobs, I'm not clearly defining how I want them to do that job, how I want them to make decisions, that's gonna create problems within my organization. It's gonna be hard for us to run efficiently as an organization. It's going to increase controls and consistency. Organizations and companies that succeed are ones that ensure their business processes and rules are well defined and that they are consistently applied. And the consistently applied is where the internal controls come in, and we'll talk about that in a minute. And it also improves operational efficiency by allowing employees to make better decisions because guesswork is eliminated, handle exceptions faster and in a better way, and puts business people in charge. So you tell them what their role is, you tell them what their responsibility is, and what level of authority they have within the organization. They know how to do their job. And then it also supports compliance initiatives. It supports audited financial statements, third-party requirements such as debt covenants, as Melinda was talking about earlier. So that leads us to internal controls. So these, to me, business processes and internal controls are the foundation of your business. If you have good business processes and you have good internal controls, your business is going to run much more efficiently, and you're going to be much more effective as a business owner or a manager within that organization. So some of the benefits of internal controls are reliability of reporting, as we were talking about, and the importance of that with third parties and also internally for you to be able to make good decisions for your business. Protect the company's assets. So I'm sure we've all heard stories about embezzlement and also understanding what assets we have available to us and what's the state of those assets. So, that's a key benefit as well. The effectiveness and the efficiency of operations, as we talked about, and compliance with applicable laws and regulations. There are two types of controls. Preventative controls are designed to keep mistakes from happening in the first place. But unfortunately, even with the best preventative controls, there still could be issues down the line. So you build in some detective controls to help identify those and correct those errors and irregularities when they occur. So to summarize, the value of data to an organization is of the utmost importance because it really allows you as an organization to have a clear path of where you're going and understand where you are and help you make the right decisions to get there. And so I'm going to turn it over to Brian now, and Brian's going to actually show us how everything that Melinda and I have talked about, they apply at Hussey.
Most everything. Good morning. I realized that in my bio it was very brief, so I wanted to just give a little quick additional background just so you can understand the perspective that I'm speaking from today. But it's also going to talk to a couple of these first bullets. So I've been with Hussey for about 15 months now. But through my almost 30 years of working in Maine here, I've worked at Bath Iron Works when Bath Iron Works had 12,000 employees. I've run a small machining business that had 50 employees, and now I'm in a company with 300 employees. So I've seen businesses, small, large, medium, different perspectives, and have had varying responsibilities in those organizations, from simply managing an expense budget at Bath Iron Works to having full profit and loss responsibility for an entire business. I've also been in situations where companies are healthy and growing, like right now, fortunately Hussey is, but have been in situations where businesses were going the other way, and have been in circumstances of transition. And again, I'll use Hussey as an example. Hussey's been around for 183 years, and until Tim's untimely passing almost 2 years ago now, which is hard to believe, the business was always run by a Hussey family member. So 181 years run by a Hussey family member until 2 years ago when, quote unquote, professional management took over the senior management roles of the business. That's created a transition for the business and created a transition for the family as well. And, I see Ann shaking her head back there and Thomas shaking his head. But my point in all of this is that data collection and financial reporting and operational reporting is situational, and it's specific to every business. So, I know probably a lot of the business owners in the room here, they might look at what I'm going to go through today that we can do as a $100 million business that has a $2 million business or a $1 million or a $5 million. You say, I can't do that. I don't have the systems. I don't have the staff. So I guess I'm acknowledging all of that and just saying that what I'm going to talk to some generalities and then just kind of walk you through some of the different financial and operating reports that we go through. So, the first one here, I said and a lot of this is kind of repetitive to what Dean was saying, but again, I want to put it in the context of it's different for every single business. But there are some things that are common. That for information to be meaningful, you've got to know what you're measuring it against. If you don't have a goal or a plan or an objective, you can get all the data in the world, but it may not be meaningful to you. Data should not be collected for the sake of collecting data. I see a lot of heads going up and down right now. Just because you read something in a business book that says I should be tracking this, it may not be pertinent to your business. It may not be important to your business. And you don't want to get the data paralysis and spend all kinds of money collecting data when, it just doesn't mean anything necessarily to your business, or it's not actionable. And, really for information that kind of leads on both of those two things, it's got to lead to action. If it's just data, sometimes data you need to report to other people, but the data you use on a daily or a weekly or a monthly basis, it ought to tell you something about the business where you say, either I need to take action or I don't need to take action. And if I do need to take action, here's what I need to do. Now, sometimes that action is, I've got to get more data, right? Because, you look at things at certain levels, and sometimes you got to dive a little deeper than your normal reporting, and hopefully you have access to that data. So sometimes that additional step is just, where do I get more data? Again, I realize this isn't always possible for everybody, but real-time or near real-time data is very important. And a good example for us, we work on a lot of large projects that can span the course of a year. If we're doing them, a major renovation to an NBA arena. We can't wait till the end of that project to know whether we're being successful or not. So there's a lot of things that we need to know on a real-time basis to determine whether we need to take some corrective course in order to get that project back on track. There are other projects, the smaller projects we work on, the small middle schools and high schools, those are often kind of in and out in the course of a month. So those are things that we just look at after the fact. What we look at for there is trends. Do we see margins going up? Do we see margins going down? Do we see trends where we might be just missing something? So again, even with our business, the way we analyze different parts of the business are really dictated by what's required to manage that business. And then the other point that I would make is, and I've seen this, I guess one thing that I didn't mention is in between the Bath Iron Works and the small manufacturing and Hussey, I provided mergers and acquisitions advisory services. So I was a user of financial statements in that case. And so I've seen a lot of small financial statements. And one of the mistakes I think sometimes people make is they try to make the income statement answer everything. And so you start to have this proliferation of cost accounts where, we had a winery before where it was wine sales and event sales, but somebody would say under wine sales, they'd have a cost account for Cabernet and Sauvignon Blanc and Pinot Grigio and, every single product they sell, and then a cost of goods sold. And you get to the point where you then have an income statement that's like 27 pages, and it just doesn't mean anything. It's lost its meaning. So don't try to have the income statement be the answer to everything. It's one of those areas where you look at it and say, okay, am I on track? And if I'm not, now where do I dive a little bit deeper? And hopefully you structured your information so you can get to it. So from I lost my, so those, I called that internal reporting. I think all of those things go for everything. But then on the external reporting side of things, I think it's important to know who the audience or audiences are for your reporting. Transparency, obviously, in terms of generally accepted accounting principles and audited financials. There are certain things that you have to report on. I think too much detail or too little detail is important when you know the audience that you're reporting to. And then the last piece is I think all reports should be self-explanatory. If reporting requires additional explanation, you got to go back and just sort of look at why that is and try to correct that. So I'll talk now a little bit about just some of the stuff that we do at Hussey on some things literally on a daily basis, some things on a weekly basis, some things on a monthly basis, quarterly basis, annual basis. I'm going to try to go through this relatively quickly because I want to make sure that we leave time for questions for all of us. So in some cases I've used specific reports. I just grabbed an example of a report. In some cases it's just a bullet list. So this is our what we call our daily performance metrics. And I apologize if you can't read it, but I'll talk to it. It's really there's three things that we look at daily and one that we look at weekly. So we look at our incoming orders on a daily basis. We're a $100 million business. You might say, well, what does one day mean? I know from having run a small business, and I know I'm going to get head shaking here, that at the end of the month, both on sales and shipments, you get the hockey stick. Right? And on the last day of the month, everybody's trying to ship everything out or get their incoming orders. And it's a dangerous way to run a business. And so we do both incoming orders and shipments on a daily basis, really in some ways to sort of keep ourselves honest and keep the people who see this honest, to say, let's focus on this daily. Let's not focus on sales and shipments on a monthly basis. Think about it as a daily thing. Because if you start to think about it as a monthly thing, and then that one thing that you expected to get that big order shipped at the end of the month, the customer calls and says, "Oh, I can't take it. I need to take it next week." Then, there goes your month. And sometimes a month of financial reporting for small businesses can make a big difference. We look at our labor on a daily basis. We operate in a standard cost environment. It's important for us to know, in essence, how much standard labor we're achieving based on our standards every day. Because if we see deviations to that, something's going on. Either we've got our standards wrong, we have efficiency issues, there might be production issues in the shop that, as a senior manager in the business, we're not always going to hear about. but want to know about, or at least want to know when things get to a certain level. So that's something that, the entire senior team looks at on a daily basis. And then we look at labor efficiency on a weekly basis. And again, a day, there's often an explanation as to why one day looks different. If we start to get weeks where we're deviating from the plan, we really need to dig in. Again, that's across the entire business. So if we get to a point where we see efficiencies are lagging, the next level down is to say, let's look at it on a department basis. So then we'll start to dig down in each of our individual departments where we can get efficiency reports. And then hopefully we don't need to go below that. But those are things that literally we look at every day. That report comes out at about 7:30 every morning. On a monthly basis, this is a long list, and I won't cover these all, but Dean talked a lot about key performance indicators. You'll see that both from this, and there's a couple I didn't pull it out here, but you'll see on what we call our dashboard, it looks a little bit different. As Dean said, everybody's dashboard looks a little different. But these are, we try to keep it to 10. Sometimes we go up, sometimes we go down, but we try to keep it manageable. And this is a good example of where the situational stuff's important, right? Everybody I'm sure who's trying to hire is having difficulty finding good employees today. That is in spades for us as we're growing in Southern Maine. So we look at every month our employee census. What was our plan? How many people did we hire? How many people did we lose? Why did we lose people during the month? Was it because we're not paying people enough? That's important information and feedback for us. Was it because they're relocating? What were they terminated? What are the reasons why we're losing people, and how many people are we hiring, and how many openings do we have? We look at decent amount in shipments. So we have our annual shipments budget. We do an S&OP, which looks at our forecast shipments, just to make sure that we're on track. And if we see some significant deviations in terms of our forecast shipments, two things we'll look at next is where does our backlog stand. We tend to, and this certainly I know doesn't apply for everybody, we tend to have a relatively large backlog in comparison to what our shipments are for the year. We're often working on long lead time and long projects. So our backlog can be as much as 65% of our annual revenue, depending on the time of the year, which makes me make one more point just in terms of the circumstance piece. We are a pretty seasonal business. You might not think that we would be, but the majority of our work goes into middle schools and high schools. And when the middle schools and high schools want their work done, they want it done in the summertime. And then, when you sort of think about the other areas where we sell into, which is a lot of NHL and NBA facilities, when are they typically empty for regular business? It's in the summertime. So we will go from, on a shipments basis, we measure our kind of core business based on the number of seat spaces, so the middle school, high school bleachers, and we will go from shipping in the slow time of the year, which tends to be kind of December, January, February. We'll ship out 5,000, 4,000, 5,000 seats a week. In the summertime, we get up to 24,000 seats a week. Wow. So it's a major scale up for us. And my point there is that, again, the reports we might look at in the summertime are different than the reports we might look at in the middle of winter. So it's everything is situational, not only to the business, but to the circumstances and even the time of year. We look at incoming orders to our budget. We look at margins. Obviously, margins really important. Maintaining margins. If we start to see deviations in margins, we start to ask ourselves why, what's going on in the marketplace. Is it cost driven? Is it sales driven? Quality, for every business, quality is important. Quality is assumed. Ours is a complex product that we make, and so quality can rear its ugly head in a number of different ways. We have a couple different ways that we measure quality, both in dollars and in occurrences, but we're constantly looking at that. On time and complete to plan. And then see towards the bottom of the list is an income statement comparison. Not that it's least important, but it's toward the bottom of the list. And this, keeping in mind, this is sort of the broad, our senior leadership team tends to be, sort of 15 to 20 people that would be involved in this type of a meeting. But we go over it at a pretty high level, and You know, our income statement and balance sheet, here's our balance sheet, here's our income statement. Pretty simple. Now, what's behind this is what my team is looking at constantly is another 9 pages of different levels of detail on this. But in terms of what we go over with the entire management team, it tends to be, you know, more focused at a high level, and what we really look at is just variances. So we'll say, you know, if on a total operating expense level, we're on budget, but within certain cost accounts down below where we're seeing some significant variances, we'll talk about those variances at our monthly KPI meeting. Try to understand, you know, if they're favorable variances, that's good, but we also want to understand why we're having very favorable variances to our plan. And if they're unfavorable, we want to understand that and see what corrective action we can take. Yeah, so I guess that's where I was going there. And I think I have shipments to plan up there twice, so I'll skip over that. This is what our dashboard looks like. Again, it's small, but just for visual purposes, I thought I'd put it up there. The one thing I didn't talk about, which is at the top of our list, is safety. If you can see the numbers, you'll see that for us, and this is our actual dashboard for the last year. We have a very good safety record, but our goal on safety is 0, and that's what we measure ourselves against. And so, you know, even the slightest hiccups and our, you know, we will have injuries. We work in a dangerous environment, but our goal is always 0 there. And so, of all of our KPIs, that's the one that we hold ourselves most accountable to, and it's typically the lowest because we set a very, very aggressive goal, which is 0. But this just gives us kind of a red light, green light, yellow light, tells us where we're at and where we need to dig deeper. And so behind each one of these things, there's data, there's graphs, there are different things where we'll dig into those things. So additional, on a monthly basis, still here, where our finance team will dig a little bit deeper, and I'm personally involved in this every month. We will look at our revenue and our gross profit. We break it down by product family and then by sales channel. So for instance, we have on our telescopic bleacher systems, we have 3 different models, if you will. On our chairs that go on those systems, or our fixed chairs, we've got, I don't know, Tom, 8, or, you know, probably 3 or 4 families with different subfamilies. And then we also have things that we sell through our dealer network, and we have things that we sell direct. And so those are different channels for us. And we look at gross margin analysis on a channel and product line basis. And then we will go through every single job we shipped in the course of a month and look at margin on each one of those projects. You know, and that could be, you know, in the course of a year, we probably ship, you know, 1,200, 1,500 meaningful jobs. There's a lot of other smaller ones in the course of the year. But we'll look at each one of those and look for major variances. And if we see major variances, or we see sort of a theme of major variances, then we're going to start to dig a little bit deeper to see if we can get to a root cause on that. And if there needs to be corrective action taken, then we take corrective action. But we will look at every single job. And on the big jobs that will span multiple months, we do, you know, those of you in the room who do, you know, long project stuff, as any construction folks in here, you know, we do project completion estimates. So we look at current costs to date, we look at estimated cost of completion, we look at forecasted margin, and again, you know, look at where we might need to take corrective action on some of those larger projects before we get to the end and say, oh crap, we lost, you know, a lot of money on that one, or we didn't make as much money as we expected to. Some other things we looked at, Dean mentioned a few of these, AR collections, days of sales outstanding. As a seasonal business, cash is really important to us, particularly in the summertime. Our accounts receivable and inventory, as you can imagine, going 4x on our shipments. In the summertime, our AR and our inventory skyrocket. You know, we rely on a line of credit for that, but you know, sometimes if we're getting to push up to the edge of that line of credit, we need to make sure that, you know, we know right where we are. And the other thing that I don't think you mentioned, Dean, that we look at there is creditworthiness. Mm-hmm. You know, particularly with our dealer network, where we're selling to the same people year after year, that we've done business with, we kind of know what their payment terms are. We know what to expect from them. So if we start to see creep where, somebody's going from a normal 45-day payer to a 60-day payer, we're going to give them a call and find out what's going on, and make sure that there isn't something that's happening that, a month later, they're going to call us up and say, oh, we're going out of business because we're not making money. And it's a good partnership for us because it's been a long-term partnership, but that's one of the good ways for us to kind of just keep on track of what's going on. Sometimes it's for good reasons. If we have a small business that is one of our dealers and their sales are going up, right? As everybody knows, right? Sales go up, AR gets tied up, your inventory goes up, that consumes cash. It typically is a temporary thing for our dealers because they are seasonal like we are. But it gives us a reason to make a phone call and kind of find out what's going on there. We look at inventory turns. Again, Dean mentioned inventory. It's the bane of many manufacturing companies' existence, having been there and done that in many lives. And then, debt to equity is always an important ratio to just sort of be keeping mindful of. So those are all things that we do internally that we're looking at within our finance department group. On a quarterly basis, we report out to the board and to the shareholders. We typically circulate a board book, and I, again, brought a prop here. We have a board meeting next Tuesday. This is what our board meeting looks like. It's got a report from the CEO, a sales report, an operations report, IT and engineering, HR, finance. We have an office in Ho Chi Minh City in Vietnam that runs what we call our Hussey Asia Pacific division. We got a report there, some strategy work, and org chart. So that'll go out to the board a week in advance. There we typically, so just in terms of what's included there, select KPIs. We don't run through the entire list of KPIs. There are select ones. This kind of goes to the know your audience. From a board perspective, there are certain KPIs that we have felt just are not, don't need to be reported on. As you can see, it's a pretty thick book. We try to keep it as thin as we can because we want the directors to read it and ask questions. And part of the reason we do that is we want, most of our board meetings not spent on reporting on what's happened, right? We want the majority of our board meetings to be spent focused on what's going to happen in the future, getting advice from our directors. That's what we have a board for. And so we want to be able to focus as much as we can in those meetings on strategic things, on future endeavors. So we try to get the reporting taken care of ahead of time. So we put select KPIs, financial results that are similar to what we look at from a management perspective, and then the reports from each of those functional areas that I mentioned. Circling back to the audited financial statements. We use Baker Newman and Noyce to do our audit. We have for a long time. I just listed a few things. Some of these have already been talked about, some haven't. For us, it's one of those sort of formal ways that we report to the shareholders and make sure that they're getting at least an annual third-party review of our financial statements. We do have an audited statement. For me as a senior manager in the business, it's important that we have a third party coming in and auditing our internal financial controls. Both Dean and Melinda talked about those internal controls. In a business the size of ours, I can't have my hands on everything. We've got a great financial team, and I trust them more than I possibly could. But having somebody, in a third-party position coming in and just looking at those procedures, and helping us refine them and make them better, certainly helps me sleep at night. Bank reporting, we do provide our financial statements to our bank. I have to be honest with you, I don't know if the bank requires us to have audited financial statements. I think they do, but it's never come up. One of the other areas for us where we often need our financial statements is from a bonding capacity. Again, I don't know if there's anybody in here who's in the construction world or has to put up bonds for certain projects. But some of the large projects we work on can be $6, $7, $8 million. And so we're often asked to provide a performance or a payment bond in connection with those. And of course, our bonding company wants to make sure that we can stand behind that if we need to. And then the last one goes to these large jobs as well. Sometimes if we're selling direct to an owner, they don't want to bond, or we're working with a large construction management firm that's building a new NBA arena or an NFL stadium, they're going to want to pre-qualify us. They can check us out by reputation, but when you're talking about a $5 or $6 or $7 million project, to do their due diligence, they're going to want to make sure financially we've got the capability to handle a project of that size. So those are some of our third-party reporting. So just to kind of wrap it up, is some of the things that I've said throughout. I think the needs of every business, and even within that business, time of year, situation, circumstance, audience, it's different. And what you really need to do is know what's important for you and what's important for the other stakeholders that are going to be receiving reports. And knowing the audience, both internally and externally, is important. Defining success, collecting data to get data just doesn't do anything if you don't know what you're comparing it to or what your objectives are. Timely and accurate, again, I realize that's not always possible, but I think if you are collecting data significantly in arrears, you've got to ask yourself the question of, is it worth even collecting that data if there's nothing I can do about it by the time I get it? Mm-hmm. I talked about this. Don't make the financial statements answer everything. Think about what's the purpose of your financial statements, both internally and externally, and what's important to have on those financial statements. Last but not least, don't let diving deep in data cause you to lose sight of the big picture. A lot of small business owners, you can manage a business by gut. You know what's important. You know by walking around what's happening in your business. So a significant amount of data isn't the right answer for a lot of people. Some data is always the answer for everybody. But just know what's important and don't become beholden to the data, both from a collection and a losing sight of the big picture perspective. So I think that was all I had. And now we'll all take questions.
I know that's a lot of detail, but there's got to be some questions. Some questions. Yes.
Question for Brian. On your daily metrics there, are those populated by your ERP system or is that manually entered?
A little bit of both. A little bit of both. Just sort of think through. It's populated by the ERP system, but there are some I'll say on the labor efficiency piece, and part of the reason we use temps as we scale up, we use temps. And the way we record temp information doesn't allow us on a daily basis to get real-time efficiency data. So you didn't notice it, but on some of the efficiency stuff, it was in red and not in black. What that means is that it's not final, hasn't been trued up to the temp bills. We try to have as much as our information come out of our systems as possible that don't require manipulation. But that kind of goes to the accuracy piece. I think you got to make sure that if whatever data you're getting is accurate, and if we were just getting efficiency data straight out of the ERP system without taking into account the temp aspect of it, it's going to be misleading for us. So it's kind of a balance of both.
Can any of you explain work in progress a little bit as far as like what that does before you record your taxes?
Oh, taxes. I knew this was going to happen.
Did they say this was going to be a tax seminar?
No.
Do you mind saying what type of business you're in?
We're in construction, flooring stuff back there.
Yeah.
So we have like long-term projects kind of similar to you. So when we, at the end of the year, our bookkeeper, we do our work in progress at the beginning of the year, at the end of the year, she does something that gets. So I guess I'm wondering.
I think it probably impacts your cost of goods sold,
Yeah.
which flows to your tax return. That's why you have work in progress.
And so my big question, I guess, like, do you analyze your numbers after that's been done or before that's been done? What's more accurate?
Well, I would say, from an operational perspective, you have a budget for a job, I'm assuming, right? You guys have already figured out what resources you need to complete that job and what you expect it to cost. So I think best practice would be that you would be tracking along the process of that project, depending on how long that project is, to ensure that you're tracking to those expectations. And if you see things are out of alignment, to Brian's point earlier, you want to dig deeper into why those deviations are occurring and really understand it, because not only can it impact your current project, but it's going to impact future projects, right? If you have pricing concerns in the market that are impacting your overall cost, you want to take that into consideration when you bid your next job. So it's not just controlling the current project, but it's also considering how that information might help you better manage future projects.
And I think too, to realize that they are two different things. There's book and tax. And so GAAP would suggest or require that you would take a look at those jobs in process and see if you've created an asset or a liability based on where you are, how many billings you've had based on the work that you've completed and vice versa, both at the beginning of the year and the end of the year. And it could generate an asset or a liability. Now that's the book aspect of things. And then you would have, the tax consequences of that. And they are two different things, but that's clearly what she's doing. And she's seeing if you have that, asset or liability that needs to be recognized, but also seeing, as Dean was pointing out, how the impact on cost of goods sold impacts your bottom line and therefore your tax liability. Would you?
Yeah, I would say, I agree. I would say it a little differently, I think, in terms of your question, sort of before or after. And the answer is after. Because when you think about, particularly if you're looking at revenue in a period and cost of goods sold in a period, right? The idea behind accrual-based accounting is to say, for what I recognize revenue for in a particular period, I want to capture my costs of that revenue. Right? And so by sort of truing up your work in process, that's really what effectively you're doing, is you're lining up the costs that you booked for that period with the revenue that you booked for that period. Right? Would you?
Yeah, absolutely. Yeah. And just to bring that down to sort of a practical level, if you're a general contractor, you hire an electrician to come in and do the electrical work, and you pay that electrician, but you're not going to bill the client until a future period, that's an asset, right? Because you haven't billed them yet. Once you build that client for that electrical work, you would recognize the expense for that electrical work. So you're saying, hey, I charged the client $10,000 for that electrical work. It cost me $8,000. I made $2,000 on that portion of the construction project. So that's an important aspect of it.
Proper matching of revenue to expense.
Correct.
Exactly.
Correct.
Shifting gears, and I don't know if this is a question for this group, but your presentation triggered this question for me. How do you know that you are in fact being successful at $100 million? How do you measure yourself? Okay,
It's a great question.
Yeah, Tim and I were in the same forum together. So the question was, for me, is I'm in manufacturing as well. I'm always wondering, how successful am I really? Because growing the top line is one thing, but we can't spend the top line. It's the bottom line.
Absolutely.
So how do we measure that success?
Yeah, I think you just answered part of your own question is, net income.
How does Hussey, because I do the same thing.
Right.
Yeah, and it's a great question. It's a question that and I see Ann shaking her head back there, and I know Tom is smiling. It's a question that we struggle with.
Right.
What is, and for us, honestly, it's, and this is a testament to the Hussey family, is, we're $100 million, but we are a family business, and we are run like a family business. And sometimes running like a family business has expenses that come with it. And so, what for a publicly traded $100 million business that's reporting to Wall Street, or that might be owned by a private equity group, what's success to them isn't necessarily what's success to us. Having said that, we still ask ourselves the question.
Right.
And, having spent a lot of time as a user of financial statements and doing mergers and acquisitions work, and people talk about comparable transactions, and there is, with private businesses, this is my personal opinion, and I don't know if either of you have ever done valuation work, and I apologize if you have.
No.
But there is no such thing as a comparable
Right.
private business to another comparable private
Right.
business. It just isn't.
Right.
You run your business different. You know, what you pay yourself is different than somebody else pays themselves. So it's a difficult thing to get good benchmark data on. I mean, I was in touch with the people at the National Association of Manufacturers, assuming they would have good data on this and collect. No, we don't really collect that. Doesn't really tell us anything because it's so, I use the word tainted. It's so owner specific.
Yeah.
Is what it is.
Yeah, and you know, the perspective that I would bring to that question is, it goes back to part of my presentation where I said you start with a business plan, a business strategy, right? You as an organization are defining what is success for you. It's going to be different for everyone. I mean, ultimately, if we're a for-profit business, we're all in the business of making money, right? So ultimately, as you said, that bottom line, if I'm a $100 million business and I'm losing money on an annual basis, why am I doing it? Why am I getting up?
We're not, by the way.
No, I'm not. I was not. But you know, that if you're a business and you're making money, you know, one of the things when I started to think about the presentation was actually doing something specific to that was throwing a number up on the board saying, hey, if I told you my business made $50 million last year, would you think that's good? On the surface, would you think that's good? Well, what's the reference point? What if I told you I made 80 million the year before? Now you don't think the 50 million is very good, right? So I think it's all a matter of perspective. What if I told you I made 50 million, but then I told you I lost $1 million? Is that good? So I think, again, getting back to what I was saying, the data tells the story. You have to look at the whole story. And I think the story starts with you as the owner and what your expectations for the business are. If your expectations are that there's a certain level of growth, there's a certain level of profitability, there's a certain level of customer service, and you're hitting those goals, then you're a successful business, right? Because
I have another thought to share on that, but I think Ann wanted to share
Yeah, I
something.
think there's many ways to measure success, and financial is certainly one of them, but there's also, you know, your presence in the community and your philanthropy efforts, and there's, you know, what's your, I don't know, I just think financial is definitely a predictable measure, but I think there are many ways to measure success.
No, I know what
Funding
Hussey
your-
Seating is all about and what they represent in the community. So I completely agree with you, Ed. But really the key, because we within our forum, we would have this wrestling, not with one another, but how do you really define how successful have you been? So you're in a marketplace, market's kind of defining the price point. So if we are within striking distance of that competitive bid, you get the bid, and now you got to make sure all these elements are coming together. So at the end of the day, you've got profit. And then there's enough profit there that allows you to reinvest back into the business to keep you current and relevant. So I guess for me is I always want to be relevant. And what are some ways that I can look at to stay relevant, knowing that I didn't give the ship away, but yet I'm still getting the most out of my process.
And I think, it sounds like you're someone who has looked to network, both probably within your industry and outside your industry. And sometimes that's the best way to get a feel for it, honestly. It's, you know, if you were to look at it from a pure financial perspective, this would be the analysis that you should do, is to say, look at your business like any other investment you would make, right? You're investing a certain amount, you have a certain amount of capital tied up in the business, that if you were to take that capital out, you could invest it elsewhere. And it's sort of that risk-return continuum, right? Is to say, I have this amount of capital tied up in this business. It's a risky, every private business is a risky business. What would be, for me, based on my risk profile, what's an adequate return on the capital I have employed in this business? And if I'm not getting it, should I take it out and put it somewhere else? That pure financial way to look at it. But that's one of the ways you could look at it from a financial perspective. Steve?
Melinda, when you're auditing work, if it's possible, I think you used the term qualify, that equals failed or not ideal.
Yeah, so an unqualified opinion means that the financial statements are materially correct in accordance with GAAP, but we might say that except for. So in this case, we were able to say that, except for the fact that you entered into an agreement that created a call option and you chose not to value that derivative, then it would have been fine. And so the unqualified is certainly the goal.
Is it possible to identify some of the most common reason you'd have a qualified opinion?
Absolutely. If we were not able to get comfortable that the financial statements were materially correct, and usually that comes in a higher risk area. So for manufacturing, that could be inventory. Another qualification I had was for a company that bought a paper mill, and they didn't have all of the assets appraised. And so we were able to offer an opinion that said that these financial statements are materially correct in accordance with GAAP, except for the fact that the company didn't appraise these certain assets, and therefore we can't speak to the propriety of the depreciation and the carrying value. So it's pretty unique company to company, but it's generally those higher risk areas that create the risk for having to qualify the report. That's a great question. Thank you.
Mm-hmm. Or if a company doesn't allow you to go inventory their inventory.
Yes, that's a scope limitation. That's another fun. So as a senior manager, I generally don't get the Hussey Seating engagements. I get the new clients, early stage companies who have these riskier situations, and so I get to see this quite a bit. And it's very interesting. I certainly have learned a lot in my career, but it's very specific company to company about what their risk profile is and where the soft spots are in their financial statements.
We're not as easy as you think.
Yeah.
Yeah, Brian, you might have said this, who gets that daily report?
All of senior management gets it.
Okay.
I'm thinking through, I'm looking at the distribution list on my inbox.
Visual.
The one answer question is, do you share with employees? And what do you share with them? And do you ever share things
We
with
do.
them?
We share a fair amount of information with employees. We have video boards up all around the company that report on incoming sales, on shipments, on efficiency. So there's data that would be reported on a monthly basis.
Okay.
The daily metrics don't go broadly out. They go to the people who should be looking at it and then taking the corrective action with employees.
Okay.
So it would be kind of to some supervisors, but mostly managers, directors, and senior management. But from a financial perspective, we share top line, we share gross profit, and we share bottom line with our employees. We have again, this is a testament to the Hussey family. We have a generous profit sharing program that's based on our operating profit. And so that information gets shared with employees. We have a monthly communication meeting with our employees where we share incoming sales, shipments, gross profit, operating income. We do a sort of a forecast for what the year is going to look like. We do an estimate of how much is going to go into the profit sharing plan. So that gets done on a monthly basis with all employees.
So thank you very much. Thank you all for filling out your surveys, and I don't really have any business cards in here, so that means nobody can win anything.
Oh,
So
my.
if you don't have a business card, you can fold your name tag in half, and I'll come around. You take it off.